All right, today we're putting two really interesting robotics companies head to head. Nauticus Robotics, which trades under the ticker KITT, and Richtech Robotics, or RR. We're going to really dig into the financials here, see what story the numbers are telling us. So let's get right into it.
This really sets up a classic David versus Goliath situation, right? You've got this robotics giant on one side, and then this much, much smaller challenger on the other. But as you know, in the world of high tech and finance, it's almost never that simple. So the real question is, how do they actually stack up once you get past all the noise in the headlines?
Okay, so the very first thing that just jumps right off the page when you look at the data is the size difference. And I'm not talking about a small gap here. It's a massive chasm. This one fact really sets the stage for everything else we're about to dig into.
And wow, this chart really drives that point home. What we're looking at here is market cap. Basically, what the market thinks the whole company is worth. Look at Richtech. It's towering up there at almost $1 billion. And then you have Nauticus, way down at just under 16 million. I mean, the difference is it's staggering.
Yeah, let that sink in for a second. Nearly 959 times $1 million. So in our little story here, Richtech is without a doubt our Goliath. That price tag shows a whole lot of market confidence.
And now, let's look at our David. Nauticus comes in at just about 15.7 million. It's a tiny, tiny fraction of Richtech's size. And this huge difference, this is the backdrop for everything we're about to compare.
Okay, so size is one thing, but it's not the whole story, right? Now we've got to look at their financial health. Let's pop the hood and really check out the engine. We're talking profitability, cash flow. This is where you see how the company is really running. Now, before we get into the nitty-gritty numbers, there's a key term we've got to touch on: EBITDA. I know, it sounds super complicated, but don't let the acronym scare you. Just think of it as a quick snapshot of a company's core profitability before you start subtracting all the weird stuff like interest and taxes. It's a really good way to get an apples-to-apples comparison of how two different businesses are actually performing.
And this is where the plot really starts to thicken. Look at this. Both companies are actually losing money right now. They're in the red. But, and this is the key part, it's the size of those losses that matters. Look across the board here: EBITDA, operating income, even free cash flow, which is basically the cash they have left over after running the business. Richtech's losses are way smaller. To put it simply, they're just burning through less cash.
So, okay, what does all this mean from an investor's perspective? Well, to figure that out, let's break things down on a per-share basis. This will tell us just how much value is packed into every single little slice of these companies. First up, let's look at cash per share. You can think of this as the company's emergency fund, just divided up by all the shares out there. And the data is pretty clear. Richtech has more cash for every share, which means it has a much bigger financial cushion. And it's pretty much the same story when you look at revenue per share. Richtech is just bringing in more sales for every single share that exists. This is a great example of how that massive size we talked about translates all the way down to the individual share level. But hold on, here's where things get a little interesting, a little twist. We're looking at capex now. That's capital expenditure. It's the money they spend on big physical stuff like buildings and machinery. And here, Nauticus actually spends less per share. Now that could be a sign that they're being more efficient, spending less on the big ticket items compared to their size. Oh, and one more thing worth pointing out is ownership. The free float, which is just the percentage of shares regular people like you and me can buy and sell on the market, is almost exactly the same for both. So in terms of how much of the company is available to the public, they're pretty much on a level playing field.
All right, so we've looked at a bunch of different data points. Let's pull it all together now and make a kind of final scorecard. We're going to weigh the pros and the cons for each of these companies, pulling straight from the summary in our source material.
Okay, and this brings us to a really fascinating wrinkle in the source material. On the one hand, the summary points out Richtech's obvious strengths, right? The massive market cap, the smaller losses, that all makes sense. But then for Nauticus, it lists higher cash and revenue per share as strengths. Now wait a minute, that completely contradicts the table we just looked at a few slides ago. It's a really curious inconsistency in the analysis.
Now on the flip side, let's look at the challenges. For Nauticus, it's pretty much what you'd expect for the smaller company. Bigger operating losses and a weaker balance sheet. Basically, more debt compared to the stuff it owns. For Richtech, the challenges are a bit different. It's those per-share numbers we talked about being lower, plus the fact they spend more on capex.
It really paints a clear picture of two companies with very, very different kinds of risks.
So what's the bottom line here? Well, you've got a giant that seems more financially stable right now, and then you have a challenger that's leaner and meaner when it comes to capital spending. And all of this leaves us with the big billion-dollar question. In a super fast-moving industry like robotics, is bigger always better? Or is there a world where the nimble little underdog can come out on top?